Shadow of Truth, and today is Tuesday, July the 7th, 2015. And your hosts are Dave Kranzler from InvestmentResearchDynamics.com and Rory Hall from thedailycoin.org. And we have the distinct pleasure of speaking with Mr. Wolf Richter from wolfstreet.com. How you doing today, Wolf?
Very well, Rory. Thanks for having me on your show.
Well, thanks for being here. Dave, what you got going on?
No, same as every other day. Just sitting here watching in amazement at what's happening to our markets. Today I thought was kind of interesting the way they decided to smash gold and silver right as the COMEX was opening up. And interestingly, the S&P 500 took a 20-point hit right after the NYSE opened up. So it's quite interesting day today so far.
That it is. Wolf, what do you think about all that?
Well, I'm looking at China right now. China is sort of maybe the predecessor of what we might be seeing later here. As you know, the Chinese Shanghai index has dropped 29% in the last 3 weeks. Well, yesterday, over the weekend, the Chinese government, the People's Bank of China, the central bank there, have held all sorts of emergency meetings and have tried to come up with numerous strategies to prop up this crashing market. And so yesterday, on Monday in China, it was weak, but rose a little, and today it fell a little. But what is happening is that the largest stocks in China are being propped up when they're actually rising, and that's just a few of them. Oil companies, state-controlled oil companies, state-controlled banks. The rest of them are still collapsing. So the Shenzhen index, where the smaller companies are trading, smaller, medium-sized companies, and the China Export, which is the Nasdaq over there, they have collapsed on Tuesday by another 5.7%, and with hundreds of companies, or 1,600 or so companies in total, going down, with hundreds of them hitting the 10% down limit, and with close to 1,000 companies on Tuesday being suspended from trading so that the shares couldn't plunge further. That's a situation and that's after a 30% crash already. So that's a situation that is really going wild right now, despite all the government efforts to stop it.
Do you see that happening here? Is that what you're alluding to?
Well, once the government and the central banks lose their power to stop markets from going down, you have a situation that sort of spirals out of control very quickly. And I don't know that it will happen in the United States. I don't have that sort of crystal ball, but we're certainly situated for a situation that could go it could fall off a cliff pretty quickly. It could be the opposite too, or sort of the opposite. It could be just 10 years or 20 years of very mediocre, a range of mediocre gains to good-sized losses, just kind of zigzagging down, like Japan did for 20 years.
Wolf, I got a question here just to sort of follow up to what your last comment. You suggested maybe this could drag on for 10 to 20 years. Do you really think that's possible, given the fact that the only thing keeping it going is money printing and debt issuance? I mean, this country, you can't print debt ad infinitum. It's got to hit a wall. And right now, we're currently paying 13 cents of every tax dollar that goes into the government gets paid out in debt interest. I just don't think that's sustainable for that amount of time.
Well, it's clearly not sustainable. Totally agree with you. What we have learned from the Japanese is that it is sustainable for a lot longer than anybody can imagine. And the Japanese are in a fiscal nightmare situation, and because central bank money printing allows them to control the bond market, and because QE still works in pushing up the stock market, they have things under control up to a point. Now, the corollary of that is that the central banks cannot control the currency. And they can control the bond market, and they can manipulate to some extent the stock markets, but they have zero control of the currency. So when you get into money printing like the Bank of Japan or the Fed has been doing, sooner or later it shows up in the currency. Japan, the yen is already down like 40% against the dollar since they started this program. So if the currency spirals out of control, suddenly the central bank can no longer get this under control. So they have to choose between letting the currency spiral out of control and keeping bond prices high, or they can let the bond prices go and support the currency. They can't do both because they're opposite movements. And Japan and probably the United States too, and every country that has its own central bank will support its government bond market and will let the currency go. And so that's the risk the United States is facing. Not that the government bond market will collapse, the Fed has that under control, but that the currency will collapse. That's the risk.
I agree with you to a point that the Fed has the bond market under control, but there's one big event that could cause them to completely lose control, and that's if we wake up one day and China has offered out all of its treasuries, bid, wanted, and comp.
Yeah, in theory, the Fed can buy $1 trillion worth of government debt in 1 second, with a click of a mouse. So that's
what would collapse the currency. You're right.
That's right. So they can continue to control the bond market regardless of what China will do, but they can't control the dollar, and obviously the Chinese will never do that because they have no interest in collapsing the dollar. They want a strong dollar. They own a lot of it. They own a lot of America. They export to America. They need a strong dollar, and they need treasuries, which they own, to remain relatively high. That's a economic interest the Chinese have. They have the United States and China are joined at the hip. If one goes down, the other goes down. So neither country, it's like mutual assured destruction in the economic sense. Neither country can afford to try to wipe out the other. And,
I agree with everything you said, except there's one critical difference between the U.S. and China, and this is
I
the
know
way
what's
that
coming.
I've played the tape forward in terms of how the end game plays out. It's actually two critical differences, but the two are related. The number one thing is China has close to $4 trillion in foreign reserves. So they got a $4 trillion cushion of foreign reserve currencies that the U.S. does not have, and only part of that's dollars. Right. And then the second critical difference, and we don't know how big a difference it is that China controls a huge pile of physical gold. And even though we can't directly prove it, it's quite likely that the U.S. government doesn't have any gold. And so I've always felt that the reason why the U.S. and China are not joined at the hip is because if the day does come when China decides to tank the U.S. dollar, the losses that they'll sustain will be completely offset by the increase in their gold holdings. Do you see what I'm saying?
Right, and I agree to some extent with that. Now, there's a third difference that I want to add to you too, and that is that the U.S. has a gigantic trade deficit with China, and China has a trade surplus with the U.S. So the trade relationship is not equal, and they're not joined at the hip in that respect. But China needs the United States for its economy to survive. If the United States stopped being an importer of Chinese goods, the Chinese economy would just collapse on the spot.
And I agree with that too. And I think China has been working pretty hard over the last 10 years to diversify its customer base, and that's a big part of what they're doing with the BRICS and the Asia Development Investment Bank, or whatever the heck it's called.
Well,
Asian Infrastructure Investment Bank, etc.
Let me jump in here, gentlemen, because you guys are overlooking two things, and you're touching on it right there, Dave. It's the Asian Infrastructure Investment Bank, the AIIB. That is the bank for the Shanghai Cooperation Organization. China is working its way into not being dependent whatsoever on Europe or the United States as far as their export economy is concerned. There's another big difference in that China has a strong relationship with Russia, and that is a critical point of departure where the United States and the Eurozone are both concerned. and they are not going to. I think that if push comes to shove, that China would side with Russia in a flat heartbeat, and say to heck with the United States, to heck with the Eurozone, dump the bonds, dump the dollars, get them out of here. We don't need them. We don't want them. Goodbye. And that's why they've been working on all of these financial infrastructures that they have, as far as the alternative SWIFT system, as far as their credit card payment system, these development banks that they've been putting together, the New Silk Road that they've been working on for 10 years or more, and the Shanghai Cooperation Organization that is at least 10 years old. And all of these things add up to the United States in particular, because of the dollar, becoming an island. And that's what I wanted to ask you, Wolf, is isn't the it seems like the United States is kind of moving into its own little world and isolating itself. I mean, how do we get out of this current mess with the dollar and the Federal Reserve System and this bond system? I mean, it just seems like that we're in a stranglehold.
Right. Now, how do we get out of this? I think we have to look at how we got into this, and which is the establishment of the Fed back in the early 1900s. And the role of the Fed has evolved over the years to where now it has become this all-powerful institution that does pretty much what it wants to. And so long as the Fed backs up government borrowing, Congress isn't going to do anything, to fix our fiscal problems. So, so long as the Fed promises to support government bonds, the government will issue more bonds, and our deficits will go up because Congress knows that the Fed will buy them if nobody else wants to. And if the Chinese bail out of the bond market, the Fed's there to step in, and Congress knows that. So nothing is going to change in that respect. The situation is just going to get worse, and just like Japan. Japan's about 10 or 15 years ahead of us in that respect, but they've got the same assurances from their central bank, and so the government has just, flooded its books with deficits year after year.
But where does that leave us? I mean, as far as what's actually happening on a global scale with everything that's going on in China, with everything that's going on in Russia, these are massive economies,
right,
that we have to depend on. We are dependent upon them, and if they shut down the Western banking systems, then where does that leave us? We have absolutely nothing, and we have no way to combat that, even through military force. I mean, we have nothing.
Yeah. And I wouldn't worry too much about Russia in that sense. Russia is a very powerful military entity, but as far as an economic entity, it is fairly small. The economy of California is larger than the economy of Russia. So Russia is a huge exporter of hydrocarbon resources, and so that's important for the world market. That's important for Europe. That could do a lot of harm by stopping the flow. That's important for China. And so China wants a good relationship with not just Russia, but also the former Soviet countries in Central Asia that are large producers, in order, for China to supply its energy needs, other than having to rely on overseas sources. And so I think that relationship between China and Russia is a little bit utilitarian, and China controls that. China has the money. China has the demand. China invests in Russia, and it's not Russia that controls it. It's China. And China is going to be, someday, China is going to be the largest economy in the world. And by some measure, it already is today, but by the classic measures, it's not. It's number two. Someday, it's going to be number one, and it will have a currency that will be equal to, or maybe down the road, maybe not in my lifetime, but down the road, will be maybe the number one currency in the world. And so there are a lot of changes going on that we as Americans haven't gotten used to yet. We are number one in just about everything, and we enjoy the privileges of it. We have a currency that is one of the, or it's the major reserve currencies, not the only one, but the major one, and that allows us to do all sorts of things. And you're totally right that someday this is going to stop, but I don't think it's going to be all of a sudden. I think it's going to be a fairly gradual change, where we're simply giving up bit by bit the power and authority in the world markets that we used to have.
That sounds about right to me, I guess.
Well, maybe it's wishful thinking. I don't really want. I don't really want to see a major collapse of the entire world system.
Doesn't sound very pleasant.
Yeah, no, not at all. Yeah.
Unfortunately, though, history tells us that these tectonic changes that sweep the globe, they happen slowly and then all of a sudden all at once. It's kind of like the old Hemingway quote.
Yeah.
How did you go bankrupt? Slowly and then suddenly.
Right.
And I think, unfortunately, the transition into, as you describe it, and I agree, China becoming the next world superpower economically and militarily, I don't think that's going to happen gradually and painlessly. I think we're headed for a train wreck, and I'm starting to wonder if we're maybe not in the final stages of the train hitting the wall.
Right. Now, there's one thing I'm still waiting for before that happens. I think there's one stage missing. China has faced 30 years, has experienced 30 years of just phenomenal growth. And it has created the most phenomenal credit bubble in the history of mankind. It has created all sorts of distortions that far exceed anything we have created. And this needs to blow up first before I think we can, or the world can move on to the next stage. I think what China is looking at right now is the cleansing of that system that it has created over the last 30 years. And depending on how it comes out of that will determine what happens afterwards. But I don't think in this current condition that China is in, as overloaded it is with debt and with non-producing assets, with overcapacity, with all kinds of things, that infrastructure that has been built that serves no purpose, that's been funded with debt. Yeah, I don't think it can move to the next level without cleaning this out. And the cleaning out part, like you said, is not likely to happen gradually. That can happen very suddenly, and that can be very painful for all kinds of economies around China, including the United States. But I think it's one of the requirements for China to move forward. It has to shed that weight. And
I guess that kind of circles us back to how we started off the conversation, which is that you had mentioned that you were kind of thinking that what's happening in the Chinese stock market might be an omen of what's going to happen to the U.S. stock market. The Shanghai Stock Exchange is down, like you said, probably 30% now since early June. You think we're going to start seeing numbers like that in the U.S. markets? I mean, we have already in some of the sub-indices. Some of these sub-indices have just gotten torched, like the Dow Jones Transports and some of the subsectors
right.
that they don't worry about propping up because no one watches them.
Right. Now,
go ahead.
I'm convinced that it is very difficult and impossible to make a significant amount of money in U.S. stocks going forward. I think they're pretty much all overpriced, way overpriced. And there's a resolution of this waiting down the road for us. And so now we have, I think there are two options. There are really three options. One option is a crash. And a crash would be very tradable. It collapses 50%, and it's possible to collapse further. It's possible to go back down to the financial crisis levels. There's no reason not to. And that would be a lot bigger than 50%. And there's another option, which is that this is a process that will be long and drawn out, and that we have essentially a slow motion collapse that lasts 10 or 20 years. where it's not tradable, where people lose interest in stocks, where every time you jump in, you get knocked down, and after a while you just give up. And it's just like it happened in Japan. And people just stopped investing in stocks there. And I think that's option two. The third option is that we have a massive bout of inflation that essentially wipes out the nominal value, that wipes out the inflation-adjusted value of those stocks. So if you have a $100,000 portfolio and it doesn't go down nominally, but you lose 20 or 30 or 40% to inflation over a few years, then you have essentially a hidden stock market crash. And so I think those are the three options. And I'm not fixed on which one. I don't know which one's going to happen.
I'd like to change gears just a little bit here, Wolf, because I know that you keep track of the housing market, and that's one of areas that Dave really pays close attention to. And what do you see the remainder of this year? Do you see what appears to be an out of control, once again, housing bubble exploding, or how do you see it playing out for the remainder of the year?
That's a good question. Excellent question. There is right now an explosion of activity in a number of cities in the United States, and I call it a buying panic. Interest rates are going up, or people are afraid interest rates are going up. Mortgage rates, might go higher, and so and prices are going higher. So people are trying to lock in what they can. They try to lock in the lower rates, and they're trying to lock in the lower prices, and they're jumping into the market. And that's happening in Dallas. That's happening in San Francisco. That's happening in LA. That's happening all over the place. In Denver, New York City. And so you have a burst of home prices right now in many of the major metro areas in the United States. Nationwide, the median home price is now back where it was during the peak of the prior bubble. In some cities like San Francisco, we're like 40, 50% above the peak of the prior bubble. And home prices are insane in San Francisco. I mean, the median home in San Francisco, where I live, is close to $1.3 million. The median home is a two-bedroom apartment. I mean, it's not a palace. And it's not in one of the brand new buildings that are popping up like mushrooms. It's in an older building. It doesn't have a view. It probably doesn't have a garage. It's just a median home. And the median income in San Francisco is around $80,000. So median household income. So, a 1% increase in mortgage rate has a huge impact. And a family with a median household income can't buy a house anywhere. I mean, they're excluded from the market. So so this is the definition of a bubble, when it economically no longer feasible for a household with a median income to buy and afford to buy a median home. So it's no longer sustainable. At some point, this is going to implode. The question is when, and that's your question. I don't see it imploding this year. We've had a really strong couple of months recently in terms of price increases. If the Fed raises interest rates in September, that's a quarter point. It's not going to raise mortgage rates that much. So I don't think there's going to be a huge jump in mortgage rates. I think that this bubble can be maintained through the year, possibly. Don't get me wrong. But, obviously the big time to buy a house for most Americans is in the spring and early summer. So that's the season right now. There are price declines naturally, seasonally, coming in the fall and winter. So we'll see those. But I think the big issue will be next year. I think we'll run into real resistance next year.
I agree with everything you said, except a curious thing has kind of happened really just in the last 4 to 6 weeks. And I live in Denver, so I know how hot Denver had been. But, a lot of the data that we get that's published by the National Association of Realtors, by the Case-Shiller, that data is actually lagged. It has a lag built into it, and the NAR doesn't publish that. But it does have a lag in it. And so, for instance, Lawrence Yun, the NAR chief economist, is out telling everyone inventory is really low. Well, guess what? There's a guy who runs a blog called the Dr. Housing Bubble blog, and he focuses on California. And he published an article the other day, and he said inventory in Southern California is up 70% from 2013.
Right.
And I know from boots on the ground experience in Denver, I drive around all over Denver every day, that activity is definitely slowing down, and it seemed to slow down about 4 weeks ago. And not only is activity slowing down, but inventory is rising quickly. And it's rising quickly all over the city, and especially in the over $800,000 range. There's neighborhoods that you can drive through in Denver where the median home is, say, over 700,000, and there's a lot of $1 million homes, and there's multiple for sale signs on almost every block now. I mean, it's quite stunning. And I've had readers who have emailed me that they're seeing the same things in their city. And not only that, it's exactly like what happened when the housing bubble 1.0 burst, which is that you had a flurry of people like panicking to buy homes. Prices were going up. Obviously, back then it was fueled by liar loans and things like that, just completely fraudulent mortgage debt. But you also had a huge influx of apartment buildings that came into the market, and every major MSA. And I know in Denver, I mean, it's shocking to drive around and see how many buildings are in process right now. And we're in an environment right now where every single building that's sort of a modern, luxurious or semi-luxurious high-rise building, they're all offering move-in incentives right now. There's a big overhang in inventory right now, and that's before all these new buildings that are being built come online. And that's exactly what happened the first time around. Is you started seeing a huge influx in rental inventory. And again, this is slightly anecdotal, but I'm seeing a lot more for rent signs sitting outside of homes that I know were purchased by investors. And it's the first time in probably 5 years that I've seen a lot of for rent signs outside of single family homes. I know the apartment market in Denver has too much inventory, with a lot more coming online. I know that the housing inventory is building up, and I know that activity has slowed down quite a bit. And we're talking about activity started slowing down in June, which is supposed to be the peak month of the year.
Right.
So I think, again, it's one of these things where, and the housing market is like this, it'll go through a quick burst where it's like, it seems like it's super liquid, and flippers start trading houses the way they trade stocks. And then all of a sudden it just stops. Right. We've seen this several times over, several decades. Because I traded the housing sector when I traded junk bonds in the 1990s. The same thing would happen. Right. And I think we're starting to see that happen right now in the housing market. And I think the second half of 2015, even though we know they're going to try and paint the numbers as much as they can, I think 2015 is going to be, the second half of 2015 is going to be pretty ugly for the housing market.
Now, there's one thing to keep in mind, Dave, and I've heard the stories about Denver for years, of how crazy the market is there, and Marita's been telling me about it and stuff. But each housing bubble, each city has its own housing bubble and its own timing. And so, for example, when the last one burst, and I think the nationwide peak was in June, July 2006, something like that. Well, it didn't. The peak in San Francisco wasn't until November 2007. So, and then the crash came in San Francisco, just like it did everywhere else, maybe more brutal even. But it was timed. They're not timed in lockstep. So I think it's great information on Denver. There's maybe a city that is way out front now with an imploding housing bubble. Everything you described is happening in San Francisco. We've had a phenomenal building boom with high rises in certain parts of the city going up like mushrooms. And so all these new units are coming on the market right now or next year, and this will have a huge impact. So San Francisco may actually be half a year or year behind Denver. So I think it's important to keep our eyes on Denver and see what happens, because that will be a harbinger of what's going to happen in other places.
Right. I agree with you 100%. And I would also just offer that, San Francisco, not only is it being a huge beneficiary of the stock market bubble, but it's also a huge beneficiary of the private equity bubble in tech valuations. and that's clearly what's driving the San Francisco real estate market. But
Right.
Southern California is rolling over also, and it's been rolling over for several months. Same thing with Las Vegas. All the same bubble cities the first time around. You're right. The bubble the first time around passed over a lot of cities, and then it passed over a lot of the same cities this time around. Phoenix has rolled over. I know inventories are skyrocketing there. Vegas, same thing.
Yeah.
Southern California. Florida, it'll be interesting to see what happens in terms of how much foreign buying activity is maintained.
Now, here there's another parallel or tangent to the Chinese. The Chinese have been huge buyers of California real estate, and foreign buyers in some markets, like in Silicon Valley, can make up, in some towns, can make up 30% of the entire sales. And so when the Chinese stock market is crashing, I can imagine that will impact Chinese money flowing out of China into the United States real estate market. So if that is already happening, that you have fewer Chinese buyers coming in, that would have a big impact in Southern California, where the Chinese are very strong, and in some parts of the Bay Area. I
think that's exactly right.
Well, I live in Nashville, and we are experiencing an absolute boom here. Cannot find a house. House prices are skyrocketing, and apparently we have an influx of people coming from all over the country due to the tax base and the fact that the 1.3 million that you talked about a minute ago, Wolf, in San Francisco would buy you 5 2,000, 1,800 to 2,000 square foot, 3-bedroom, 2-bath houses here.
Right.
And they would be nice houses. I mean, so I think that a lot of people are flooding out of these other overpriced markets like San Francisco and coming here. I mean, that's what I keep hearing anyway.
Well, that would certainly add another wrinkle to a housing bubble like in San Francisco, when you have people looking for value leaving, and we've had the last housing bubble. I know some programmers that started going to Detroit, in 2008, 2009, because that for $70,000 they could buy a huge loft, in downtown Detroit. And there's a programmer culture back then just starting up, and it was getting pretty cool. And they were bailing out of the area here because they had to work so hard just to maintain a roof over their head. And in Detroit, they could work half as much, save a lot of money, and live in a space 5 times as large. And it makes a lot of sense. And it did revitalize certain parts of Detroit and a small section. It didn't do much good for the rest of it, but it did have some impact there. And so if you have the same thing happening now, that people from San Francisco are leaving selling their $1.2 million apartment to move into a mansion in Nashville, that would definitely be a hit to the market here.
Yes. And that's I believe that's what's going on here in Nashville. I mean, because it's completely nuts and has been for well over a year.
So housing bubbles they're great when you're in it and you own a home and you see the value jump up on a monthly basis. So housing bubbles have a huge impact on the economy, and when they implode, they reverse that impact.
Yeah.
And it's a devastating experience for local economies. And that's why housing bubbles should be avoided. And of course, the Fed is just in no mood to avoid anything like that. And local governments love housing bubbles because they make a lot of money off of taxes and the economic activity they engender. And so people who own homes love housing bubbles, and the companies love housing bubbles. So most everybody loves housing bubbles. That's the problem. And so we'll have them.
I don't love it.
I think it's crazy.
I can tell you that right now. I don't love it.
and the thing is, we know what's going to happen. There's nothing surprising about it. This is totally predictable. And unlike the stock market, the housing bubble, people don't have to live inside stocks and they don't have to live inside bonds, but they do have to live inside homes, and that's the natural limit. And so, housing bubbles are predictable with their behavior.
Predictable and even more destructive on the downside than the faux wealth they create on the upside. And I think that's part of the reason why the Fed has, more than half of the QE that the Fed has created has gone into buying mortgage paper.
Right.
And to me, that's a frightening thought.
Yeah, it is. And, there's another tangent back to the Chinese. They own a lot of that mortgage paper. And the Fed actually bailed out the Chinese.
That's right. Remember that. They strong-armed the U.S. into buying the mortgage paper. And what they did is they agreed to swap out of the mortgage paper and they would take short-term treasuries.
Yeah.
And that's what the trade was, that unwound their position in the mortgage paper because they knew it was fraudulent.
Yeah. Well, Wolf, you've been very generous with your time today, and we've kept you a little bit longer than we anticipated, and certainly appreciate all the wisdom that you've shared with us. And I certainly hope that we can do this again in the not too distant future.
That'd be great. Thank you, Rory and Dave, for having me on your show. It was great.
Thanks for being on, Wolf. This was awesome. I would actually love to have you back maybe in 6 or 8 weeks, and we can do a whole show just on the housing market.
Okay. That would be interesting. I mean, maybe we'll have a little bit more data then.
We definitely will.
Yeah. Well, what you said about Denver, I've heard from my readers for months or really a couple of years, about the bubble in Denver and how hard it is to buy a home there, and they're bidding on a house, and there's 50 other people bidding on it. And I've heard all these stories, and now you're telling me that it's already peaked and it's coming down. I mean, that's a really important insight. So, I'd love to have more data on that as we go along and see what's really happening, because there's always one city that is first in this stuff.
You're right. It led the first bubble up and down, and I think it's gonna do the same thing here. This in Southern California.
Yeah. Well, I'm going to keep my eyes on San Francisco. I think if we have a major stock market swoon, say the NASDAQ going down 25% and the IPOs start grinding to a halt and new money stops flowing into startups, and Twitter and other bigger companies starting to lay off people, you'll see the housing market turn in San Francisco and Silicon Valley. It'll turn quickly, yeah. Yeah. Yeah, I mean, they created 80,000 jobs or something like that in San Francisco the last, 6 or 7 years, and a good part of those jobs may go away. So, that's in the last tech bubble that blew up. So that would be the 2000 bubble blowing up. They lost about 100,000 jobs in this area. So in San Francisco, I think they lost 50,000. So that's a big thing, because San Francisco doesn't have that many jobs. There's only 800,000 people living here. So, well, and so these people go home, they leave and they go back to wherever they came from. And so you have all these empty apartments left. And that's the boom and bust cycle we know here very well. I mean, San Francisco lives by booms and busts, and everybody takes them for granted now.
Well, we need to end that. And the only way to do it is to end the Fed. So.
Yeah, I agree with you.
Well, like I said, Wolf, you've been very generous with your time, and maybe we'll get back in touch with you here in just a few weeks and pick up on the housing market and have our own housing market 2.0.
That's right. I've been looking forward to it, Rory.
All right. Well, thank you so much for your time.
Oh, real quickly, I think the readers need to hear where they can find Wolf's excellent writing.
And that's at wolfstreet.com.
That's right.
One word. All right, Wolf. We'll talk with you soon.
Okay. Thank you very much.
Thanks, Wolf. Bye-bye. Appreciate it.